Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. AT&T reported earnings this week, and like Verizon before it, we're starting to see some progress in generating free cash flow from the business. Operating cash generation is up, capital spending is down. That's the kind of news that you want to see from a stock that's trading in the single-digit price to earnings multiple, very high dividend yield. You want to start to see cash generation, because if the previous trends continued, they were just not a sustainable combination. So we're taking steps in the right direction. I want to dig into the numbers and show exactly what I think about the results. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content and check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. And let's go to the press release first. Revenue for the quarter was up 0.9%, so not a big number there, $29.9 billion. But cash from operations, this is what's really starting to improve. $9.9 billion, up 8% from a year ago, and up $1.2 billion in the first half of the year. That was after relatively low operating cash generation in the first quarter. Free cash flow, $4.2 billion. And management said that they're confident they can hit full year free cash flow of $16 billion or better. If we move over to some of the operating metrics, they seem to be moving in the right direction for AT&T. Postpaid numbers are up slightly. Revenue per user is up. That then leads to the fact that mobility services revenue is up. And that's really what you want to see growth in, is the mobility services, not in hardware sales. Even fiber is doing relatively well, which is, I think, a little bit surprising. It's a relatively small business for AT&T, not generating a ton of EBITDA, about $1 billion in EBITDA. So the biggest focus that we should have right here is the mobility business, and that seems to be operating pretty well at the moment. This is a little bit further breakdown. You can see that the margins here on the mobility business are really strong, 43% EBITDA margin. That's exactly what you want to see. So that's why you want to see growth in this mobility segment. Postpaid phone additions, the growth is slowing a little bit and churn is coming up. So that's something that we want to keep an eye on. That's consistent with the trends that we saw at Verizon earlier in the week, but nothing to be too alarmed by. AT&T does still have a big wireline business. So consumer wireline up slightly, business wireline starting to really decline. This is one that I'm going to be watching because it seems like businesses are making very different decisions than consumers right now. So maybe some different dynamics on who is taking market share from which one of these segments. It seems like Verizon is doing a little bit better with business customers and AT&T is doing better with consumers. So we'll keep an eye on that in the next few quarters. And then capital allocation, always important, $132 billion in net debt, but there's about a $4 billion reduction in net debt for the quarter. So again, very similar to what we saw at Verizon, that cash is starting to come in, starting to make the balance sheet look a little bit better each quarter. I think what we're seeing at AT&T is very similar to what we saw at Verizon earlier in the week, and that's that we're exiting a phase of investment where buying 5G spectrum, building out that 5G network, very, very costly for both of those companies. And now we're at the point where you need to start generating cash from those assets. And that's exactly what we're seeing happen. For AT&T, the consumer business looks to be very strong. They're both adding subscribers and able to increase prices slightly. Look for both of those things to continue. I would like to see them try to move into the 5G business. So that's basically broadband that comes in through a 5G connection instead of a cable or fiber connection. That could be a big growth opportunity. But right now, I think the big takeaway is that cash flow is strong, capital spending is coming down, and there is now more than enough cash to continue paying the dividend. AT&T's dividend yield is 7.5%, so that's a very high dividend yield. The good news is that once investors get a little bit more confident that that dividend is solid, I think the dividend yield should come down, which means that the price of the stock will go up. The reverse has been happening over the past year or so. And I think for these telecom companies that are generating cash and generating enough to both pay down a little bit of debt and pay their dividend, that should help the stock prices long term. But when you maybe need to see a little bit more consistency in that cash generation story, because we're just coming out of a big investment phase. So solid results for me. Telecom stocks may be starting to get a little bit more love from investors. So that would be welcome news. But what did you think about the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.